Hi, this is Vocal, and this is the Peachtree Securities Case 1 presentation. Question 1. The return on 1 year T-bill is risk-free, since it doesn't wear accounting to the state of the economy. The T-bill return is independent of the state of economy because the estimate return is 8% at all time. The only possible factor affecting a T-bill may be inflation. Question 2. The expected rate of return for T-bill is 8%. T-bill is 13.5%. Gold Hill is 8.8%. ST500 is 15%. If we were only to consider the expected return, the SP500 appears to be the best investment since it has the greatest expected return. Question 3. The T-bill's standard deviation is 0, and the coefficient is 0. T-bill's standard deviation is 11.7%. Coefficient is 0.8678. Gold Hill standard deviation is 9.1%. Coefficient is 1.034. SP500 standard deviation is 16.4%. Coefficient is 1.0933. The standard deviation provides a measurement of the total risk by examining the techniques of the probability distribution associated with the different possible outcomes, whereas the coefficient of variation measures risk per unit. The coefficient of variation is a better measure when investments has different expected returns and different levels of total risk. When risk is considered, the best alternative depends on how much risk the investor is willing to take. The SP500 may be the stock with the greatest expected return, therefore is also expected to have the greatest standard deviation. Question 4. The expected rate of return for Gold Hill is 8%, T-bill is 13.5%, so the portfolio's expected rate of return is 11.15%. The standard deviation is 2.89%, and the coefficient is 25.92%. And it is less risky than the individual stocks. Question 4. The characteristics of the two investments that reduce risk are the fact that it is diversified. If portfolio contains 75% Gold Hill or 75% T-bill, the average return for Gold Hill will be 9.98% and T-bill will be 12.33%. The standard deviation of the 4.48% for Gold Hill and 6.89% for TICO. Doing the 55% or 25% portfolios would both be riskier than just doing Gold Hill and TICO even leave 10,000 at peace. Question 5. This portfolio doesn't have the same risk reducing effect because they are not negatively correlate, but positively correlated with each other. TICO would be a part of the SP 500, which also means they are positively correlated. The question 6. The portfolio risk would be decreased, and the implications are that investors should diversify their portfolios by adding different stocks as well as securities that are negatively correlated. They should become well diversified to eliminate the risk that is diversifiable. This will then only leave market risk in the portfolio. Question D. Would you expect this to affect the company's cost of capital? Yes, I would, because if one company that they invest in has a return of 3% and another has a return of 9%, then their cost of capital is 6%, which can be increased or decreased depending on the rate of return of the individual stock. The total risk is the combination of diversifiable risk and market risk. Market risk is the risk that can't be diversified and is the risk associated with the market. Diversifiable risk is associated with a specific company and can be diversified. And an investor who has a single stock portfolio would not be expected to be compensated for all of the risk. Question 7. Those lines are called linear regression lines. The distance between the plot points and the regression line show how attainable or unattainable the return really are. Question 8. The required rate of return is 12.2%. TICO has a higher required rate of return than the market, so it should be purchased. Question 9. If inflation expectations went by 3%, about the estimate, TICO's required rate of return would have to go up by 3%. Therefore, the required rate of return would move from 12.2% to 15.2%. And the TICO's, for question B, the TICO's required rate of return would increase to 12.8%. And if TICO's beta rose from 0.6 to 1, the TICO's required rate of return would be 15%. According to the EMH, stocks are always in equilibrium. Investors can never beat the market. Additionally, according to the EMH concept, the expected rate of a stock would be the required return of such stock. The concept doesn't consider plant property and equipment. EMH does in fact corporate decisions since according to this concept, stocks are fairly valued because its price is a reflection of public information. Jack may consider uh, acquiring personal with knowledge on EMH because this uh, hypo, hypothesis seems to work. Question 10. In this case, with the Tico's data ratio decreasing, the riskiness of the company would also decrease, which is probably a good thing for the company, and Tico's beta would also be lower as a result of declining data ratio. That's because people would consider that investing in this company would be less would be less risky since they own less data. Finally, its required rate of return should be lower since investors are worried to invest into something too risky, so they do not need high rate of return.